Two of the major tech companies that are currently being recommended on the internet because they are trading at low multiples are Google and Adobe. If I had the chance to buy these two companies, I would buy them. Of course, at the right price because Google is synonymous to many people to the internet, while Adobe, I'm currently editing this video on Adobe Premiere Pro. These are two wonderful companies, and it is important for us to ask ourselves whether they are at the right price or not. And something interesting that the main issue with both companies are the same: AI, artificial intelligence. Both companies have their modes currently being challenged by AI. Let's talk about Google first. This is the cheapest one if you look at PE ratio. It is trading currently at a PE ratio of 20. And it is expected, of course, that Google will generate more income in the coming years, and the PE ratio, the forward one, will be even lower, which looks good because for a company growing at such a fast rate with such a big moat, a PE ratio of 20 actually looks undervalued. But we need to know what actually are the earnings of Google. If instead you look at price to free cash flow ratio, it tells you a different picture. Usually with such companies, you would expect the free cash flow to be higher than the net income because these are companies that generally pay their employees with shares. There are many ways that these companies preserve cash. But lately, this has not been the case. It's because capital expenditures for these companies have been much bigger. Google has net income of $100 billion, but $72 billion in free cash flow. The capital expenditures are real cash expenses, but because of accounting, these companies are allowed to amortize this cost over time. So over time, the net income also will be affected, will be lower than it is currently. So the margins of the company itself is going down. Okay, which one should you use, free cash flow or net income? Or maybe something in between. It's actually easy to determine what matters. Let's say a company is growing at such a rate today. This is the amount of profits it is generating. So how much cash does it need to generate that profit and to maintain it? This is the important question. If let's say Google has spent more money to maintain that profit, then this expense has to be counted. Whether it is counted today or it is counted in 10 years, it is a real expense and it affects the intrinsic value of Google. And based on all of this, I can say that Google today is not undervalued, according to me. And if I'm just going to compare it with, let's say, Meta, which was really undervalued in 2022, and Apple, which was really undervalued in 2016, these companies were trading at P ratios of, for Meta it was 10, for Apple it was 12. These are really generational buys, as people are calling Google today, which is not. At a P ratio of 20, and if you include those expenses that are being made, it is, let's say, 25. It's not a generational buy. Definitely not. It's not really about the P ratio. I have companies with P ratio of 30, which I believe are undervalued because they are growing at such a fast rate. So it's not just about the PE ratio. You have to take all the expenses into consideration. If the expenses are necessary for growth or to maintain the current operations. And Google, those expenses are to maintain their competitive edge. Without this, yes, people will still use Google, but they have to adapt to AI. They have to adapt to AI. It's something they have to do. In 20 years, I'm sure people will still be using Google. It will still be the most popular search engine on the internet. But to maintain the current market share, they have to make expenses. And these expenses that they are making, for example, those big acquisitions of $32 billion, it's not worth it in my opinion. This is cash that is not going to the shareholders. It's being lost. $32 billion for an acquisition, it's lost. If, of course, over the long term it produces more value, then it works. But I'm not sure why. I think they overpaid for Wiz. Let's talk about Adobe now. Adobe has a different strategy compared to Google and other tech companies. Instead of building the infrastructure themselves, they are paying other companies to use their infrastructure. What do I mean? Let's say you're using Adobe today for their AI. Yes, it is internal, even the cloud you're using, but it is built on Azure, which is owned by Microsoft, and of course, Amazon Web Services. They have to pay Microsoft and Amazon. And Amazon and Microsoft, they have to make the capital expenditures to build those data centers. Adobe is building their own, but it's not that big. There is the disadvantage that they don't own it, so they have to always leverage other competitors. But at the same time, it means that Adobe has lower cost because to maintain these data centers, there's a lot of depreciation cost that comes with it. And if you are going to keep building data centers as your number of users are growing, you need more capital expenditures, which is not the case with Adobe. They will have a lower margins compared to other companies, but at the same time, they are going to save on capital expenditures. But for them to remain competitive, if they are not spending on capital expenditures, they are doing it for research and development. Compared to the other tech companies, they have one of the highest R&D to revenue ratio. As long as Adobe can make better products or better bundles than the competitors, people are going to use their products. And once you have got used to something, it's hard for you to change. I use Adobe Premiere Pro. I could have used iMovie for free, but I rather pay for, I think it's $20 a month for Adobe Premiere Pro than use iMovie for free, because I will have to learn how to use it, and I don't know if everything is available there that I'm using, even though this is very simple editing. And I have Adobe Express and other things in the subscription, which I did not really ask for, but I'm using Adobe Express. I use it to make thumbnails, for example. The business of Adobe is a little special because they have the cash coming in at first, and then over the long term, they are going to deploy the services. So revenues are recorded in the future. You will see that they have on their balance sheet a liability called deferred revenues, which is not a real liability, and actually they can use the cash to buy back shares, which they have been doing. But at current price, once again, I will say it is not undervalued, because you have to make comparisons. Maybe for you it is undervalued, but for all the companies I'm looking at, and by the way, you can find all the companies I'm looking at on the Superinvestors Club. I have all my research there, all my analysis. It's a way to support this channel because we don't make a lot of money on YouTube. So if you're interested, please have a look at it. I also have investing courses which are available there. So please do check it out. If I'm going to compare all the companies I'm following, Adobe is not that undervalued for me to make an investment. If the price falls further, let's say by 50%, definitely I will buy, because it is a wonderful company. You always need to make the comparisons. Yes, some companies are better than others, and you should be willing to overpay a little for these companies, but don't overpay and make them overvalued. You overpay for something that is undervalued but remains undervalued. So instead of you buying, let's say, at 70% intrinsic value, it is a really good company, you might be willing to pay 80% intrinsic value, but not 120%. Currently, the market is not doing that well, and there are some companies that are really undervalued. I'm taking the opportunity to buy these stocks, but Adobe and Google are not on the list for the moment. I hope soon they will be, but for the moment they are not. If you're interested to know what I'm buying, I will recommend you watch this video next. Have a nice day and goodbye.